assessment and what he's advising his clients. So Ganesh, good morning. Thank you for joining us. What's your market assessment? I mean, this frankly has been a year where we've seen more choppiness. And after yesterday's move, looks like volatility is also back.
Yeah, we've been cautious for a while now, and what the crux of the reason has been when we did a bottom-up exercise a couple of months back and tried to estimate how fiscal 25's earnings can take shape for our coverage universe of about 250 stocks. We kind of sliced and diced the whole expectation, and our assessment was there isn't much. Market share upside for companies. There isn't much pricing upside. There isn't a lot of raw material prices led tailwinds upside left. There isn't a lot of EBITDA margin or operating leverage upside left. There isn't a lot of valuation upside. The core key call is, can volume growth recover? Okay, that's the core, that's the key potential driver left for earnings growth. And for volume growth to pick up, you need strong macro. And for strong macro, we are not too confident of thumping the table. We think it's a very binary macro. We are not very bullish on overall macro outlook for this year. And there are multiple reasons for it. And the main part for that is in consumption. Consumption has been weak. We are not seeing jobs or wages, or if the retail unsecured credit slows down, we think consumption can remain weak, has been weak, but it can get weaker. And we are a little watchful on that space. Okay, that's one. Second is, we think post-elections, the government's capital expenditure, which has been a very strong driver of overall growth for the last, say, 4 years, we think it can start moderating. I'm not saying it will decline, but I think it will become 5-6% kind of growth next 2-3 years. So that is also something which could slow down our earnings growth expectations. So our corporate capex will pick up. So we are working with that in our expectations, but we think when consumption, exports, and government capex, when it slows down, at the broader level, we will be a little more defensive, more watchful than we were earlier. So what we have done is have a barbelled approach to portfolio construct, which is 2 segments. One is the defensives, the quality names across sectors, managements who have a track record of performing across cycles. That's one side of the barbell. And the second is industrials, and where we think corporate capex picking up will be drivers for some companies. We also are positive on pharma as a sector, but a fair bit of it has also run up over the last 6 months. So that's one last point is we have been recommending kind of building up some dry gunpowder. So basically some cash in our construct and recos.
So if your view on macro and consumption and other demand trends is not bullish, that means market could see a earnings disappointment and PE compression could happen. So when you say put some gunpowder, why just some gunpowder? I mean, one should have a lot of gunpowder, because then if the economy slows down, which is what nobody's penciling in, then we could be looking at 15-20% easy downside.
I don't take a nifty call. I take sector and stock calls. But what we do is also keep imperatives in mind. How much cash can anyone maximum go to? Institutional investors is so a fair sprinkling of defensive stocks also needs to be kept in mind in that context.
Let's talk about consumption. Now we can look at two-wheeler sales, we can look at the FMCG sales and talk about the K-shaped recovery. But there are a lot of macro callers and economists was making a case that luxury has done well in 2022 and 23, urban has done well in 2020 and 22 and 23. It's the rural economy which actually will make a comeback because inflation is settled and hopefully we'll have a good monsoon. So what are the chances that what has not done well in last 2 years could do well, and what has done well may not do well?
Actually, we have not there is a slightly different view that we have. I will still not say that rural has been weak over this few years. Actually, if you look at how has tractor sales done not the current year, but the preceding 3 years, tractor sales were good actually. So I think consumption patterns are changing even in rural quite significantly. You look at e-commerce companies, even the likes of Flipkart or Amazon, and they give you pin code wise data. You look at, actually they are growing very, very well, okay, in rural pockets. So I don't want to fall into this trap of saying that rural has been slowing down. I actually think that consumption patterns have been changing there as well. In the incremental spend of the consumer has been more towards categories that were historically not a large proportion of his spend. It could be on, say, electronics, certain categories of electronics, more towards, say, like mobile phones or accessories related, AirPods and earphones and the likes. Spend on that has become a very, very large line item in excess of 5 lakh crores actually. So those are things that are changing the historical patterns of consumption that we are used to seeing, which are more FMCG, two-wheelers, or QSRs, or it could be footwears and apparels. I think the consumer has evolved a lot differently to how they are spending, and we need to be watchful of that as well.
Ganeshram, hi, morning. Let's also understand your take in specific on the PSU banks.